Welcome back to AlgoBot, where we break down automated trading strategies for MetaTrader 5, one expert advisor at a time. I'm your host from AlgoBot, and today we're exploring a strategy called Camarilla Breakout Continuation. This is a pivot-based, trend-day approach that watches a ladder of levels built from yesterday's price action and looks to join strong, one-directional moves. By the end of this video, you'll understand how the Camarilla levels are calculated, how the entry and exit rules work, and how risk is managed using the average true range indicator. Let's get started, and remember, this is educational content only. So what exactly does this expert advisor do? Camarilla Breakout Continuation is built around the Camarilla Pivot System, a classic set of intraday reference levels. Every trading day, the strategy takes the previous day's high, low, and close, and constructs a ladder of levels from them. The two levels it cares about most are called H4 and L4. These are the wide outer rails. There's also an inner band, made up of H3 and L3, and a central pivot for context. The traditional reading of Camarilla pivots goes like this. While price stays inside the inner H3 to L3 band, the day is considered rotational, and many traders fade the edges, expecting price to swing back toward the middle. But when price forces a close beyond the wider H4 or L4 rail, that rotation has arguably failed. Order flow has become one-directional, and what many traders call a trend day may be underway. This strategy is designed to take the continuation side of that move. Rather than fading the edge, it aims to join the breakout. When a bar closes above the H4 rail, the strategy signals a long. When a bar closes below the L4 rail, it signals a short. It's an approach that suits intraday timeframes such as 15-minute, 30-minute, and 1-hour charts, and it can be applied to any symbol because its risk is measured with the average true range rather than fixed point distances. Who is this style suited for? Educationally speaking, it's built for traders who are interested in momentum and breakout behavior, and who prefer a rules-based, systematic approach rather than discretionary decisions. As always, trading involves risk. Losses are a normal part of the process, and nothing here is a promise of any particular outcome. Let's walk through the mechanics step by step. The first job every day is to build the Camarilla levels. The strategy accumulates the running day's high, low, and close directly from the closed bars on your chart. When a new calendar day opens, it finalizes the day that just ended and calculates the levels from that completed day's data. Here's the math in plain terms. First, it measures the prior day's range, which is simply the high minus the low. The H4 rail sits above the previous close by that range multiplied by 1.1 divided by 2. The L4 rail sits the same distance below the close. The inner H3 and L3 levels use the same range multiplied by 1.1 divided by 4, so they sit closer to the close. And the central pivot is just the average of the high, low, and close. Once those levels exist, the strategy watches each newly closed bar for a breakout. For a long, it checks two things. The previous bar's close must have been at or below the H4 rail, and the newest closed bar must close above H4 by an extra buffer. That buffer is a fraction of the average true range, controlled by the breakout buffer parameter, and it exists to filter out marginal pokes through the level that aren't genuine breakouts. When both conditions are satisfied, the strategy reads this as a trend day to the upside and signals a buy. The short side is a mirror image. The previous close must have been at or above the L4 rail, and the newest close must fall below L4 by that same ATR buffer. When that happens, the strategy signals a sell. Now for risk management, which is entirely ATR-based, so it adapts to any symbol and any volatility. When a long is placed, the stop loss is set below the entry by the stop multiplier times the ATR. The take profit is placed above entry at the reward ratio times that same risk distance. With the default settings, that's a stop of 1.2 times ATR and a target of 1.8 times the risk, giving a reward to risk of roughly 1.8 to 1. The short side mirrors this exactly. Finally, discipline. The strategy allows only one open position at a time, caps the number of entries per day, and skips any signal when the spread is wider than your chosen limit. Remember, this describes the logic only, not any expected result. Let's look at the actual MQL5 code as it appears in MetaEditor. At the top, we have the input parameters, the settings you can adjust before running the expert advisor. ATR period is the look back for the average true range, defaulting to 14. ATR stop multiple, at 1.2, sets how far the stop sits from entry. TpRewardRatio, at 1.8, defines the take profit as a multiple of that risk. BreakoutBufferAtr, at 0.15, is the extra clearance a close must make beyond the rail. Then we have the maximum trades per day, the maximum spread in points, the order volume in lots, and the magic number that tags this expert advisor's positions. Just below, the code computes two working values from the current ATR, the buffer distance and the risk distance. Now the two signals. The long condition, long break, is true when the previous close was at or below the H4 level, and the current close is above H4 plus the buffer. When that's the case, the code reads the ask price as the entry, sets the stop loss 1 risk distance below it, sets the take profit at the reward ratio times risk above it, and calls trade.buy with those levels. The short condition, short break, is the mirror. It's true when the previous close was at or above L4, and the current close is below L4 minus the buffer. Here the code takes the bid price as the entry, places the stop 1 risk distance above, sets the take profit the reward ratio times risk below, and calls trade.sell. Both sides share the same ATR-based risk model, just in opposite directions. That's the entire trading core in a few lines. Let's bring the logic to life on this illustrative chart. On screen, you can see a price chart with the Camarilla levels drawn as horizontal lines. The wide outer rails are the H4 breakout rail near the top and the L4 breakout rail near the bottom. Between them sit the inner band levels, H3 and L3, and the central pivot in the middle. These are the levels the strategy built from the previous day's data, and they stay fixed for the session. Watch the opening candles. Price is drifting gently around the central pivot, rising and falling inside the inner H3 to L3 band. This is the rotational phase, the part of the day where the classic Camarilla reading expects price to stay contained and swing between the edges. The strategy does nothing here. It's simply waiting. Now notice the third candle. Price pushes up and tests the H3 level, the top of the inner band. On its own, this is not a signal. The strategy is watching the wider H4 rail above. On the very next candle, momentum carries price higher, and it closes decisively above the H4 rail, clearing it by more than the ATR buffer. This is the condition the strategy has been waiting for. The rotation has arguably failed, and a trend day to the upside may be underway. You can see the buy entry marker appear right where that candle closes above the rail. As the order goes in, two levels are set immediately. The stop loss sits 1 ATR-based risk distance below the entry, just back inside the range, where the breakout would be considered false. The take profit sits further above, at the reward ratio of 1.8 times that risk. Watch what happens next. The following candles push higher in a clean, one-directional run, exactly the trend day behavior the strategy is trying to join. Price climbs, extends, and finally reaches the take profit target, where the position closes for a gain in this illustration. That completes the long example. A rotation, a confirmed close above the H4 rail, an entry, and a run to target. Now let's follow the second scenario, the short side. After that push higher, price begins to roll over. The candles turn down, giving back ground and sliding back through the inner band. Price crosses below the central pivot and continues lower, testing the L3 level at the bottom of the inner band. Once again, touching the inner band alone is not enough. The strategy is watching the wider L4 rail below. Then it happens. A candle closes firmly below the L4 rail, clearing it to the downside by more than the ATR buffer. This is the mirror image of the long condition. A trend day to the downside may now be underway, and you can see the sell entry marker appear at that candle's close. Just as before, the risk levels are placed instantly. The stop loss sits 1 ATR risk distance above the entry, back inside the range, and the take profit sits the reward ratio times that risk below. From there, price follows through to the downside. Each candle steps lower, extending the move, and eventually price reaches the lower take profit target, closing the short in this illustration. Notice how symmetrical the two trades are. In both cases, the strategy waited for the rotational band to fail, required a full bar close beyond the outer rail plus a buffer to avoid false breaks, and then join the direction of the move with a clearly defined stop and target. That buffer and that full close requirement are what separate a genuine breakout from a brief poke through the level. And because the stop and target are measured in ATR, the very same rules adapt automatically whether the market is calm or busy. This is the core idea of Camarilla Breakout Continuation, illustrated end-to-end. Of course, this is a clean textbook example. Real markets produce losing trades too, which is a normal part of any strategy. And that brings us to the end of our breakdown of the Camarilla Breakout Continuation Expert Advisor. Today we covered how the Camarilla levels are built from the previous day's high, low, and close, how the strategy signals a long on a close above the H4 rail and a short on a close below the L4 rail, how the ATR-based stop-loss and reward ratio target manage risk, and how the code brings it all together. Remember, everything in this video is educational content only, and not financial advice, a recommendation, or a solicitation to trade. If you found this helpful, please like the video, subscribe for more MetaTrader 5 strategy analyses, and leave a comment telling us which strategy we should explore next. You can find more at www.algobot.live. Past performance does not guarantee future results. Trade responsibly.